Today's video is a fun one. I want to share with you 4 stocks that a lot of investors have never heard about before. And these are stocks from all different sectors, and one of them isn't even a US listed stock. And what is even better is all of these stocks have beaten the S&P 500 index over a 5-year period, and some of them actually outperforming the index over a much longer timeline. If you have any of these companies in your own portfolio, do let me know in the comments below. And as always, this video is not financial advice. The whole point of these videos and this channel actually is to bring you companies so that you can then take that and go and do your own research. And just quickly before we jump into stock number 1, I actually send out a free newsletter every single Sunday. So if you want to make sure you are an investor that receives that newsletter, please sign up. It's completely free using the link in the description below. Right, let's get started. The first one that we have today is a company called Transmedic Group, ticker symbol TMDX. This is a medical technology company who are focused on organ transplantation, and they have a technology platform called Organ Care System, OCS, and that technology platform is completely revolutionary, and it's used for preserving organs that are then used for the treatment of end-stage liver and heart failure. Now, the Q4 earnings that they quite recently posted were actually really strong for Transmedic Group. They reported a 159% revenue increase from Q4 2023 compared to Q4 2022. And they also reported a 159% revenue increase from 2023 as an entire year compared to the previous year, 2022. So revenue growth seems to be going well. Net income was another interesting financial because they actually reported a $4 million net income for Q4 2023. Now, this actually compared to a net loss of $6.7 million in Q4 2022. Now, moving forward for this company, there are talks and there are expectations that they will actually expand into new organs, which seems to be a really weird thing for me to sit here and say, but they are looking, or there are talks that they are looking to actually expand into kidneys. And this, of course, will help future growth. But even at the moment, they are managing to increase in market share. And unfortunately, just due to probably the health of the world these days, which is, of course, declining, it's not improving. Most of the population in most developed countries are, it's going downhill, which is unfortunate. But anyway, that just means that the need for organ transplants is not slowing down. And right now, the problem with organ transplantation is that the supply is restricted. And this is partly due to the inability to get functioning organs from donors to recipients, to physically get those organs from one place to another. For a long time, the only method that has been used to actually do that is cold storage, but that has its own issues. Actually storing the organs on ice or whatever they do, cold storage, but that has a lot of issues, and Transmedic Group are really trying to find solutions to the problems seen in that method. And they are doing this with their OCS, which I just mentioned. And this system actually tries to replicate the natural environment that the organs are in. This obviously has a lot of benefits, but one thing here is that it costs around $80,000 per use. So clearly it's a very expensive solution, and this could in theory actually limit the adoption. However, like with a lot of things, you can look over at the tech industry, any other industries. During those initial stages of growth, the adoption is smaller, the costs are more costly, but over time, hopefully what you see is an S-curve develop, and actually the costs can come down due to, higher increase in adoption rates. Now, looking forward to the rest of 2024, they actually expect total revenue for the full year to be in the range of $360 million to $370 million, which would actually represent a 49% to 53% growth compared to the company's prior year revenue. And a big thing should happen in 2024, and that is that this company should become profitable. And then they should actually start to achieve higher margins over the next few years, which of course should have a knock-on effect and actually help the stock. Another quite bullish thing for this stock is that a lot of big institutions, the likes of Vanguard and BlackRock, actually own quite big stakes in this company. So they are obviously predicting, they are seeing that something big big is coming up for the future. And right now there is limited competition, which is a great thing for any potential investors to hear, but this doesn't mean that this will continue for the future. The reason for this limited competition as of right now is because Transmedics OCS system is the only FDA approved multi-organ platform. In this area, you have to get FDA approval, and that is a very lengthy, very difficult process. So we can see that Seeking Alpha analysts and Wall Street analysts are both rating this stock currently as a buy. And remember, if you do want a free trial to Seeking Alpha, which is my preferred platform to do all of my research on, I will leave a link in the description. That link will also get you money off. Anyway, revenue growth year over year, A+, best it can be rated. Revenue growth forward looking, A, again, very, very good. We can also now have a look and see what this company has been doing compared to the S&P 500 index. So we'll start with year to date. Obviously, not a very long time period, not the most valuable information to really look at, but it has underperformed the index. However, now let's expand to a 3-year period. We can actually see a very different picture. Over a 3-year period, Transmedics Group have been able to outperform the S&P 500 quite significantly, but it has been a lot more volatile in the process. Expand into a 5-year period, look at this. Absolutely fantastic. Returning investors 359% compared to an 83% return on the S&P 500. And over a 10-year period, you can see not very valuable to look at just due to when this company went public. Next up, we have Jabil, ticker symbol JBL. They actually operate in a very, very different sector compared to the previous company that we just looked at. And actually, they are an electrical and manufacturing services global company, and they operate across 100 locations in 25 different countries. Now, they make a very, very diverse range of different products, ranging from medical devices to circuit boards and lots of stuff in between. And you can see their portfolio here. They are involved in healthcare and packaging, to networking and storage, to 5G wireless and cloud, to the auto and transportation industry. Very, very diverse indeed. And you may not have ever heard about this company before, but actually they have some of the biggest, most massive customers in the world. For example, I read that 5 customers account for nearly 50% of their total sales. And actually major customers like Apple account for about 20% of their total revenue. Other significant customers that they have that you definitely would have heard about include Cisco, HP, and Dell. Now, of course, if we see that a few customers are accounting for, a big portion of the total revenue, the total sales of a company, this could be kind of risky in terms of revenue diversification. If one of those companies have problems, pull out of the deal, no longer require products from Jabil, that could really, really put a strain on them, and it will have a massive, massive impact. However, it does seem that over time they are becoming less reliant on some of the bigger names, but we'll have to just watch that moving forward. In terms of revenue from different markets, you can see them on the screen now. Currently, this company does have a $2.5 million stock buyback authorized scheme, and they have been growing EPS, free cash flow, and revenue. At the end of 2023, they also made an agreement with BYD Electronics, which will boost the company's presence in electric vehicles and sustainable energy sectors. And these areas do tend to have higher margins compared to some of their other markets that they're in, which should be really, really positive for Jabil. And something quite big has happened recently for this company. They have actually re-entered the S&P 500 index after a 7-year period of absence. So we have some mixed ratings on Seeking Alpha. We have 2 holds and a buy, but let's just have a look at what the growth is being rated. Okay, so revenue growth year over year and forward revenue growth isn't coming out so well, but the overall growth grade is coming out as a B. And then if we look at profitability, you can see some mixed ratings here. Some of them very good, some of them not so good. So this company actually does pay a dividend. Very, very small in terms of yield. You can see some information here, and you can see that it is a quarterly dividend paying company, meaning investors will get paid 4 times a year. And you can see some dividend grades here as well. I do think Seeking Alpha is fantastic if you are a dividend investor. Gives you literally every piece of information you could ever need. But let's just have a look at how this company has been performing compared to the S&P 500. So we'll start with a year-to-date view. Pretty similar, to be honest, just slightly underperforming, and you can see quite a big drop happened here, which accounted for that. If we expand out now to a 3-year period, wow, look at that. 156% compared to 30.45%. 5-year period, again, way outperforming the index and then some. And we can expand to a 10-year period here as well, just so you can have a look what's been going on. The third stock is actually a UK-based company, and I don't think a lot of people, UK investors included, have actually ever even thought or heard about this company. They are called RELX, R-E-L-X. They are global providers of informational-based analytics and decision-making tools for both professional and business customers. The main company is RELX, but actually this company has a lot of subsidiary companies that come off of it. And the company is actually organized into 4 main segments. They have their risk segment, which actually offers data and analytic tools to help customers with risk assessments and fraud prevention. They have their scientific, technical, and medical segments, which help researchers and healthcare professionals advance science and improve health outcomes. And they do this by combining information and data sets with analytic tools to actually facilitate insights and critical decision-making abilities. One of the subsidiary companies actually also publishes the Lancet and the Cell, which are two massive scientific medical journals that I became very familiar with during my degree. Then we have legal. So this provides legal, regulatory, and business information and analytics to do things like help lawyers win more cases. Lastly, exhibitions. This segment helps run conferences and obviously exhibitions. So this company is incredibly diversified, and from the most recent data I could find, the revenue split is actually as follows. Risk takes up 34% of revenue, STM is 33%, legal is 20%, and exhibition is 12%. Now, one thing that I liked about this company when I did some research, and obviously if you're going to add this to your portfolio or any stocks I discuss, please go and do further research. A lot more is needed than what you see in this video. But I really like that they are committed to innovation. And they actually invest in artificial intelligence, machine learning, and data analytics, which is honestly getting more and more rare to actually see UK companies be at the forefront of this stuff. We tend to see it from the big US tech companies. So it's really refreshing to see. The RELX business model, I hope I'm saying that right, R-E-L-X, RELX, I guess, focuses on subscription-based products and services, which, is really helpful in terms of providing a steady revenue stream. And that's probably one reason actually that they've seen pretty good financial stability and growth. There has been strong demand across all 4 of their segments, and I think if they can continue to focus on innovation, new services, new products, AI integration, and actually allowing that to streamline their business, they might actually be able to continue to grow moving forward. And like the previous company, they are also planning to buy back stock, and they actually intend to buy back £1 billion of shares in 2024. This is another company that pays a dividend, and I'm just showing it on a different website because I want to see it in British pounds here because they are a British company. They actually pay twice a year, and their dividend yield is currently 1.9%. So, nothing crazy, but sometimes high dividend yields can be a little bit suspicious. Looking at their growth over time, very good picture here. You can see that since 2012, they have been consistently growing their dividends. Now, of course, it makes sense to actually compare this company to the FTSE 100, which is kind of like the UK equivalent to the S&P 500, if you will, the 100 or so largest UK-based companies. And we can see year to date, RELX has actually outperformed the index, but let's just expand to a 5-year period. It has returned investors 102.39% compared to the FTSE 100 index, returning investors just over 7%. Max it out here, you can see the FTSE 100 has been around for a little bit longer. However, RELX has performed extremely well. And if you look from this point here, May 2012 or around that time, what a return they have seen. Last up, we have a company that some of you seasoned investors would have definitely heard about, but other people perhaps not. It's a company that does operate in the tech AI sort of space, but it's not Nvidia, it's not Palantir, it's not Tesla, it's not Google, it's none of those companies. It's actually a massive conglomeration of various tech companies called Broadcom, ticker AVGO. Now, Broadcom is actually one of the leading semiconductor stocks within the market, but they actually do everything from enterprise software to semiconductors to broadband infrastructure software. So again, like a theme with actually a lot of these companies today, they are pretty diversified. In Q1 2024, they reported a revenue growth of 34% year over year. They also recently acquired a company called VMware as part of a $61 billion acquisition. And that part of their business is now accounting for a significant revenue of the software infrastructure segment. So far, this looks to be a really, really positive acquisition that they made. However, this acquisition has meant that their debt levels have risen even more. Now, they do seem to be paying down their debt, but it's no hidden feature that actually this company does have high levels of debt. And this isn't their only acquisition in the last decade. You know, they do quite a lot of acquisitions and they are really, really focused on expansion and growth. You can see here, based on the 2024 guidance, that they are actually estimating that the majority of their revenue will come from their semiconductor solutions, with the slight minority from their infrastructure software. And you can see how that's split out here. I really, really like the diversification. Semiconductor solutions are things like networking, server storage, broadband, wireless, and industrial. And infrastructure software include mainframe, distributed, cybersecurity, which again is another buzzword at the moment, storage area networking, and cloud infrastructure. Taking a look on Seeking Alpha, I'm just actually on the growth section. And we can see that revenue growth year over year is coming out as a B, revenue growth forward looking an A-. And let's just have a look at the profitability section as well. You can see many different things here, but just the profitability grade overall, A+. Ratings, buy, hold. And then this company does actually pay a dividend. And you can see dividend growth, very, very strong, consistently growing their dividends over 13 years. Not a massive, massive dividend, but still, you know, they're paying quarterly. And if you are an investor who wants to be involved in the AI and tech growth that we're seeing, but perhaps you're looking for a slightly more diversified company, maybe one that you can get a bit of income in, a very established company, this could be worth looking into for you. But now let's have a look at how this one has been performing compared to the index. So year to date, outperforming the index, returning investors 21%. 3-year period, great performance here, 174%. 5 years, like I said, all these companies have outperformed the index over a 5-year period. This company, no different. 341.56% compared to 83% from the index. 10 years, you know, this is really one of those companies that have just done so well, and that doesn't seem to be slowing down, especially given the world that we're now living in and how AI is moving forward. But a lot of investors are focusing on the Nvidia, on the Google, on the companies like that, and actually turning their head away from a company like this could be worth looking into. Maxing it out just so you can see that here. Of course, not as long timeline as the S&P 500, but done so well. Personally, I don't actually have any of these companies, just to be fully transparent, in my own portfolio. But if you do and you like them or you're looking to add any of these, let me know in the comments below. I hope I have been able to introduce you to at least one new stock that you can now go and research and see what you think. But until next time, keep analyzing, keep investing, and don't forget to hit that subscribe button. It's absolutely free and it helps this channel grow. It helps get more eyes on this channel, and I would really appreciate that. Thank you so much.